Imagine lying in bed staring at the ceiling. It is quiet in the room, but your mind will not settle. You are thinking about the future. You are thinking about your money. Will it be enough? Will it grow? Or could it all vanish overnight? You are not alone. This is a worry that has sat quietly in the minds of millions. From someone working a regular 9-to-5 job, to a wealthy retiree, to a seasoned economist with decades of experience, the same question lingers like a shadow behind every financial decision. Will the stock market always go up? This question is not just about money. It is about trust. It is about the future. It is about whether the time you spend working, saving, and investing will lead to something better, or whether it might all disappear in the next big crash. Let us start from the beginning. For over 100 years, there has been a belief passed from generation to generation, a belief shared by financial advisors, retirement planners, books, and family dinner tables. It goes like this. If you invest in the stock market and hold on long enough, you will make money. Always. No matter what happens in the short term. It sounds so comforting, so easy. Just buy some stocks. Wait, and eventually they will go up. History, after all, seems to support it. From the 1920s through the 2010s, the American stock market, especially the S&P 500 index, returned close to 10% per year on average. That figure, adjusted for inflation, falls closer to a real return of about 4 to 7% depending on the source. According to research published in the Review of Asset Pricing Studies by Oxford University Press from 1960 to 2017, the real return was about 4.45% per year. Not bad at all, especially compared to leaving your money in a bank account, earning close to nothing. Over time, that kind of return creates powerful results. $1,000 invested in 1920 could have grown into over $1 million by 2020 if you reinvested the earnings and let compounding do its work. This is the magic of the long term. It creates hope. It gives people a reason to believe. But here is the catch. History is full of ups and downs, big ones. People lost fortunes in the crash of 1929. Stocks fell nearly 90%. It took over 20 years just to return to the same level. The 2000 dot-com crash wiped out billions in paper wealth in just months. And in 2008, millions of investors saw their portfolios cut in half as the global financial crisis unfolded. Every time the market crashes, people ask the same question again. What if this time is different? What if it never comes back? There is a reason we worry. Money is not just paper or numbers on a screen. It represents safety. It stands for food on the table, a roof over your head, medicine when you need it, a future for your children. When money feels at risk, our most basic human needs feel threatened. That is why we cannot sleep. Some people think the rich do not worry about these things, but they do. Wealth managers for the ultra-rich, such as those at JP Morgan Private Bank or Goldman Sachs, constantly analyze market data, diversify portfolios, and hedge against risk. They know the stock market has been kind over time, but they never take that kindness for granted. Even famous economists, with deep knowledge of markets and decades of study, often disagree on whether this long-term upward trend is guaranteed to continue. Nobel laureate Robert Shiller, known for his work on market bubbles, has warned repeatedly that market optimism can turn into dangerous assumptions. He points to times in history when people believed prices would never fall again, only to be proven wrong. So why do so many still believe in this idea that stocks always go up? It comes down to what has happened so far. Since the Great Depression, governments and central banks have stepped in during crises. The Federal Reserve lowers interest rates. Congress passes stimulus packages. Banks get bailed out. These moves often help bring markets back to life. That creates a pattern, a belief that no matter what happens, someone will step in, and markets will recover. But that belief is being tested. Today, inflation is rising. That means the money sitting in your wallet or savings account is losing value every year. Prices are going up, but your cash is not. The Federal Reserve has raised interest rates to fight inflation, but that makes borrowing more expensive. That hurts businesses. It slows down the economy, and that makes investors nervous. Meanwhile, traditional savings accounts and bonds are paying only slightly more than before, and still far less than inflation. That leaves people with few good options. The stock market seems like the only path forward, but it is a path filled with uncertainty. So here we are, everyday workers trying to build a retirement fund, parents saving for their kids' college, retirees living on a fixed income. They all face the same question. Is the stock market a safe place for their future? Should they believe in the promise that it always goes up? Let us take a moment and think of someone you might know. Let us call her Maria. Maria works as a school teacher. She is careful with money. She saves a portion of her salary every month. She listens to advice. Her bank suggests putting her savings into a mix of mutual funds. Her financial planner tells her to ignore the noise and stay invested long term, but Maria still worries. She watched her parents lose a chunk of their retirement savings in the 2008 crash. She sees news about trade wars, tech layoffs, and debt ceilings. She reads headlines saying a recession might be coming. Her instincts tell her to pull her money out. But then she remembers the old promise. Stay in. Stocks always go up in the long run. She is not looking to be rich. She just wants to feel safe. That is the core of this entire issue. We want to feel safe. We want to believe that our hard work today will turn into something better tomorrow. We want to believe that investing is not gambling, that it is based on something real, that companies will keep growing, that markets will keep rising, that history will repeat itself and not betray us. And yet history does not move in a straight line. What we know for sure is this: the market has gone up in the long run so far. That is a fact. But the path has been anything but smooth. There have been long stretches of losses. There have been decades where gains were flat. There have been people who invested at the wrong time and had to wait years to recover. And not everyone had the time to wait. So the promise that stocks always go up is not a guarantee. It is a possibility, a strong one, supported by data, but not a certainty. And this matters more now than ever, with inflation climbing and interest rates rising, with world economies deeply connected, with climate change affecting business costs, with political tensions flaring across continents. The question is not just about the stock market anymore. It is about everything that influences it. That is why this story matters. In this journey, we will explore the truth behind the numbers. We will look at history, not as a collection of charts and statistics, but as a story of real people living through real events. We will ask why some investors thrived while others failed. We will explore how companies grow and how markets recover. And we will be honest about the risks, because you deserve to know what really drives the market. You deserve a clear picture, not just hope. The road ahead will be long. There will be moments of doubt. There will be hard truths and hopeful lessons. But by the end, you will be better prepared, not just to invest, but to understand. And that understanding is what brings peace of mind. So let us begin this journey together, not with a promise, but with a question. Will the stock market always go up? Let us find the answer. Let us take a deep breath and look back. Not just a few years. Let us go back a full century. 100 years is a long time. It holds wars, revolutions, discoveries, crashes, and recoveries. It also holds one of the most surprising stories in modern finance. The story of how the stock market became a kind of modern myth, a place where money seems to grow almost magically over time. Many people today believe the stock market is the best place to grow wealth. Some believe it is the only place. They say that if you buy stocks and just hold them, you will win in the long run. But where does that belief come from? Why do we think it is true? The answer lies in what has already happened. Let us go back to the early 1920s. Back then, the United States was coming out of World War I. Factories were humming, cities were growing, people were hopeful. That decade, known as the Roaring Twenties, saw a big rise in stock prices. The economy looked like it could keep booming forever. But then came the crash of 1929. That crash changed everything. It did not just shake confidence, it destroyed it. Stocks fell more than 80%. Many people lost everything. It led to a worldwide depression. Unemployment soared. Banks failed. Families struggled. And for a long time, people stayed far away from the market. They no longer believed in it. But something unexpected happened. The market came back. It took time. It took years. But the Dow Jones, the most well-known stock index, eventually climbed above its pre-crash levels. Not only did it recover, it kept growing. Even with World War II, even with oil crises in the 70s, even with recessions, assassinations, political scandals, and terrorist attacks. By the time we reached the 21st century, something incredible had happened. From the 1920s through the 2010s, the US stock market had delivered an average return of about 10% per year. This includes both good times and bad. That number is not adjusted for inflation. When you account for inflation, the real return is lower, closer to 4 to 7%. A peer-reviewed study published in the Review of Asset Pricing Studies by Oxford Academic calculated that from 1960 to 2017, the real return of the market, after removing inflation, was about 4.45% per year. That might not sound like much, but it adds up in a way that seems almost unreal. Let us look at a simple example. Say you had $1,000 in 1920. You put it in a low-cost fund that tracked the market. You reinvested all your earnings. You never touched it. By 2020, that $1,000 would have grown to over 1 million. That is not magic. That is math. That is the power of compound growth. It is what happens when your money earns interest, and then that interest earns more interest, again and again. It is like a snowball rolling down a hill. At first it is small, but as it rolls, it picks up more snow, then more. And before you know it, you have something massive. That is what compounding does with money. Still, the journey was not smooth. There were long stretches where it felt like the market had lost its way. After the crash in 1929, it took until the mid-1950s for stocks to fully recover. During the stagflation of the 1970s, markets barely moved while prices and interest rates soared. In 1987, there was another sudden crash, known as Black Monday, where stocks fell over 20% in a single day. Then came the dot-com crash in the early 2000s. Technology stocks had risen so fast in the late 1990s that many believed a new era had begun. But it collapsed, wiping out years of gains. Not long after, in 2008, the global financial crisis hit. Banks failed, housing markets crashed, stock portfolios were cut in half. Yet again, the market came back. This cycle of loss and recovery is part of the pattern. It is not a straight line. It is more like a roller coaster that slowly climbs higher, even while it dips along the way. Economists call the rising parts bull markets. These are times when prices rise, optimism grows, and investors feel confident. The falling parts are bear markets. These bring fear, panic, pain. From 1926 to 2023, there were over 20 bear markets in the United States. Most lasted less than 2 years. Some were short and sharp. Others were slow and grinding. But in almost every case, a bull market eventually followed. The rebound often came faster and stronger than people expected. That is part of why people kept believing. They saw the pattern. Fall, rise, fall, rise, over and over. But this is not just an American story. Many other countries have seen similar results. In Britain, the stock market has also delivered solid long-term gains, even through wars and political shifts. Germany, once destroyed by war, rebuilt its economy and saw markets rise. Japan, although still struggling to regain its 1989 peak, has seen more recent recovery. In fact, according to data published in Emerald Insight and the Journal of International Financial Markets, Many developed markets have shown positive long-term returns when viewed over decades. Still, not every country has followed the same path. Some have faced years or even decades of stagnation. Japan is a striking example. In the late 1980s, its market soared during a massive economic boom. But when the bubble burst, it did not recover quickly. More than 30 years later, it has still not returned to those heights. This shows that history does not guarantee future results. It only gives us clues. So why do we still trust this system? Part of the answer lies in what the market really represents. When you invest in stocks, you are not just buying numbers. You are buying pieces of real companies. Companies that make things, sell things, solve problems, serve people. Over time, these companies grow. They hire workers. They expand into new markets. They invent better products. That is what drives value, not just prices on a screen, but real-world progress. The stock market, in this sense, reflects the work of millions of people building something. It grows when businesses grow, and businesses grow when societies grow. That is the deeper truth behind the numbers. But the market also reflects our emotions. Fear can drive it down. Greed can push it too high. Panic causes crashes. Confidence fuels rallies. It is not just a machine. It is a mirror of human behavior. That is why it moves the way it does. Sometimes it makes sense. Sometimes it does not. And that is why looking back is so important. History gives us perspective. It helps us see the bigger picture. It reminds us that pain is part of the process, but so is recovery. It shows us that while the short term is often wild and unpredictable, the long term has been more stable, more consistent, and more rewarding. That is the lesson hiding in a century of data. It is not that the market always goes up every day or every year. It does not. It falls often, sometimes hard, but over long periods, when measured in decades, it has shown a strong tendency to rise. And that is why people keep returning to it, not because it is perfect, but because it has worked more often than it has not. So when we look back through time's window, we do not see a smooth road. We see storms. We see sun. We see long, hard winters and beautiful, bright springs. We see people who lost everything and others who quietly built fortunes over years of patience. The past does not promise the future, but it whispers something to those who listen closely. Stay calm, stay steady, stay long, because in the long story of the stock market, that is how most of the wealth was made, and that is the story that brings us here, ready to look ahead. Let us step away from the flashing charts and shouting news anchors. Let us stop for a moment and look deeper, not at the prices of stocks, but at what those stocks really are, and why they have the power to build wealth over time. When people talk about the stock market, it can sound like something far away, something cold and technical, full of numbers, risks, and complicated terms. But at its core, the stock market is simply a collection of real businesses, companies with real people, real products, and real goals. This is the first and most important truth to understand. A stock is not just a number that goes up or down on your screen. It is a tiny piece of a company. When you own a stock, you own part of that business, even if it is just one small share. That share represents a claim on the company's profits, on everything it builds, on everything it sells. This is why stocks have value. They are not just guesses or games. They are backed by real work and real success. Now let us talk about how that success happens. Every business wants to grow. That is what makes it valuable. When a company grows, it earns more money. That extra money becomes profit. Some of that profit might be returned to shareholders, but much of it is used for something even more important. Reinvestment. Reinvestment is a simple idea. The company takes its profits and puts them back into the business. Maybe it builds a new factory. Maybe it hires more workers. Maybe it designs a better product. This cycle keeps the company moving forward. The more it reinvests wisely, the more it grows. Let us look at an example. Think about a coffee company. At first, it has one shop. It does well, so it opens a second shop, then a third. Soon it spreads across the country. Now imagine that coffee shop becomes Starbucks. That is how reinvestment can turn a small idea into a global giant. Growth does not happen by luck. It comes from hard work, planning, and smart use of money. But reinvestment is not the only reason companies grow. There are other powerful forces at play. One of them is population growth. When there are more people in the world, there are more potential customers. That means more people to buy shoes, phones, clothes, food, or insurance. Every person adds to the size of the economy. As the population grows, companies have more chances to sell. More sales mean more revenue. More revenue, when managed well, becomes more profit. In the United States alone, the population has grown steadily for over a century. Globally, the story is even bigger. Billions of people have joined the global economy. Many of them are young and full of potential. They want homes, cars, phones, laptops, medical care, education, entertainment. All of these are things that companies provide. This connection between population and business growth is well supported by academic research. A study published in the Journal of Economic Perspectives explains how long-term economic growth is closely tied to labor force expansion and productivity increases. More people means more workers. More workers means more output. That helps businesses grow their customer base and their workforce at the same time. But people are not the only source of growth. Technology plays a huge role too. In fact, technology may be the biggest growth engine of all. Every time a company invents a new way to do something faster, cheaper, or better, it becomes more valuable. Think about the invention of the assembly line, or the personal computer, or the internet. These were not just tools. They changed the entire structure of business. When companies use technology to cut waste, improve products, or reach new customers, they grow faster. They earn more with less. That increases profits. Investors notice. They buy more shares. That pushes up the stock price. This is not a theory. It is history. Look at companies like Apple, Amazon, or Tesla. Each one used technology to create something new. They did not just sell a product, they changed an industry, and their stock prices reflected that change. Technology makes companies more efficient. Efficiency is like oxygen for a business. It lets them do more with the same resources. Over time, that becomes a major source of value. So we have talked about reinvestment, we have talked about population growth, we have talked about technology. Now let us talk about something we all feel, but do not always understand: inflation. Inflation means prices go up. It means the same dollar buys less than it did before. For most people, inflation feels like a burden. It makes food, rent, and fuel more expensive. It eats away at savings. But for companies, inflation can be a little different. Many businesses can raise their prices along with inflation. If the cost of raw materials goes up, they pass that cost to the customer. If workers want higher wages, the business adjusts its prices. This is not always smooth. But over time, many companies manage to grow their earnings faster than inflation. That is why stocks have often been a good way to protect buying power. While cash loses value during inflation, stocks tend to rise, because the companies behind them continue to earn profits in today's dollars, not yesterday's. This link between inflation and stock returns is well documented. According to research published in the Quarterly Journal of Economics, equities often serve as a partial hedge against inflation, especially over long periods. So holding stocks is not just about making money, it is also about protecting money. Finally, there is one more force we must explore, a big one: global expansion. In the past, companies mostly sold to people in their own country. A German company sold to Germans. A Japanese company sold to Japanese. But now, we live in a connected world. Trade moves across borders. Products are shipped across oceans. Services are offered online from anywhere. Today, a company like Nike sells shoes in more than 100 countries. A company like Netflix streams movies to over 200 million people around the world. Even small businesses can reach customers through the internet. This is the power of global markets. It multiplies the number of people a business can reach, and it gives companies the chance to grow far beyond their home turf. When companies expand globally, they reduce their dependence on one country or one economy. That can make them more stable and more valuable. A peer-reviewed paper in the Journal of International Business Studies found that firms with global operations tend to experience higher growth, greater stability, and stronger profitability than domestic-only firms. So when you own a stock, you are not just betting on one country. You are often investing in a business that operates worldwide. That can be a huge advantage. Now let us bring it all together. Stocks are not just numbers, they are parts of real businesses. Those businesses grow through reinvestment, population, innovation, inflation protection, and global reach. Each of these forces adds value. And when you own a stock, that value belongs partly to you. That is the quiet magic behind the money machine. It is not really magic. It is the slow, steady result of millions of people building things, solving problems, creating products, and serving others. Every factory built, every app launched, every delivery made, it all feeds into the company's growth. And when the company grows, so does the value of its stock. That is why the market over time tends to go up, not because of luck, but because the engine underneath it keeps running. And that engine is powered by real life, real people, real progress, real work. And that is something worth believing in. Picture a quiet morning. You sip your coffee. You glance at the news. Then you see the numbers. The market is falling. Fast. Maybe it is 10%. Maybe it is 20. Maybe more. Your heart skips. Your stomach tightens. You feel the fear rising in your chest. This is how it begins for many people. A simple number on a screen. Then panic. Market crashes are not just about money. They are about fear. They are about doubt. They are about the sinking feeling that everything safe is no longer safe. That feeling spreads quickly, sometimes faster than the facts. Let us talk about why that happens. Markets are made by people with hopes, fears, and instincts. When things go well, people feel good. They buy more. Prices rise. Confidence builds. But when something goes wrong, even a little, that confidence can break. Fear enters the room, and when fear spreads, it spreads fast. This pattern is old, and it keeps repeating. Go back to 1929. It was late October. Stock prices had been rising for years. People believed the good times would last forever. But cracks had been forming. Too much money had been borrowed. Stock prices were too high. Then the selling began. It started slow. Then it turned into a wave. Then a storm. The crash of 1929 wiped out fortunes. Banks failed. Businesses closed. Millions lost their jobs. It triggered the Great Depression, one of the darkest economic times in modern history. Next came 1987. That year, the stock market fell more than 20% in one single day. People called it Black Monday. No war, no recession, just panic. Computers had just begun to play a bigger role in trading. They made the fall worse. They sold faster than any human could. That day changed the rules of how we manage markets. Then came the dot-com crash around the year 2000. The internet was new. People were excited. Everyone wanted a piece of it. Stock prices for tech companies soared. Even companies with no profits saw their stocks explode in value. It felt like the future, until it did not. Suddenly, investors realized they were paying too much for too little. The bubble popped. Stocks fell hard. Some companies disappeared overnight. Others lost most of their value. It took years to rebuild trust. Then came 2008. This time it was housing. Banks gave out risky loans. Those loans were bundled and sold across the world. At first it looked like everyone was winning. Home prices were rising. Banks were making money. But under the surface, the system was full of cracks. When people started defaulting on their mortgages, the cracks became holes. Then came the collapse. Lehman Brothers, a major bank, failed. Other banks followed. The stock market crashed. Millions lost their homes. Unemployment spiked. Governments had to step in. These crashes seem different, but they all share something in common. They were not just about money. They were about emotions. Greed drove prices up. Fear pulled them down. Let us pause and talk about that. Greed is easy to understand. It makes us believe we cannot lose. It tells us that prices will keep rising forever. It makes us invest too much, borrow too much, ignore the risks. Then when things change, fear takes over. Fear tells us to sell everything. It tells us to run. It makes us forget the long term. Fear spreads faster than facts. And when enough people act on fear, it becomes a force of its own. It pushes prices even lower, which creates more fear, which causes more selling. This is how crashes feed themselves. Now you might wonder, How long do these crashes last? The answer is not forever. Most bear markets, which are defined as market drops of 20% or more, last between 1 and 2 years. According to research published by Morningstar and the National Bureau of Economic Research, the average length of a bear market is about 14 months. Some are shorter, some are longer, but they do end. And what happens after the crash? Recovery. Slowly at first, then faster. The market begins to rise again. New money enters, new businesses form, confidence returns. The history of the stock market shows that after every major crash, the market has bounced back, often stronger than before. Let us go back to the crash of 2008. In just over a year, the S&P 500 lost more than 50% of its value. But by 2013, it had fully recovered. By 2020, it had grown far beyond that. Even the Great Depression, as devastating as it was, gave way to one of the strongest economic booms in history after World War II. Why does recovery happen? Because people do not stop working, companies do not stop selling, innovations continue, needs remain. Over time, the real value created by businesses rises again. The market reflects this deeper progress. It might move with fear in the short term, but in the long term, it follows the real economy. That is why understanding market crashes is so important. They are not the end of the story. They are painful chapters in a longer book. Every crash teaches a lesson. The crash of 1929 taught us about the danger of unchecked speculation. It led to the creation of the Securities and Exchange Commission and new rules to protect investors. Black Monday in 1987 taught us about the risks of automated trading. It led to circuit breakers that pause trading when the fall is too steep. The dot-com crash taught us to look beyond hype. It reminded us that real profits matter. The 2008 crash taught us about systemic risk. It showed how one part of the economy can bring down the whole. It changed how banks lend. It changed how they are watched. These lessons help make the system stronger. They help protect us from the same mistakes. Still, fear never fully disappears. Even today, when markets wobble, the old fears return. Investors ask, is this the next big crash? Should I get out now? Will it all fall apart again? These are natural questions. Fear is human, but history gives us a guide. Crashes are part of the market's rhythm. They come, they go, they hurt. But they also reset the system, they clear out the excess. They remind us to stay grounded, and then the rebuilding begins. For those who stay invested, who do not panic, who look beyond the storm, history has offered rewards. This does not mean the market is always right. It does not mean there are no risks. But it does mean that long-term investors have a reason to stay calm. The peer-reviewed research supports this. A study published in the Journal of Finance found that markets tend to deliver strong average returns over long periods, even after major downturns. Another study in the Financial Analyst Journal showed that panic selling during crashes often leads to poorer outcomes than staying the course. So when the sky falls down, what should we remember? That fear is powerful, but it does not last. That crashes are painful, but they are not forever. That markets fall, but they rise again. And most of all, that the future is not written in today's headlines. It is shaped by what people build after the storm has passed. Because after the fall comes the climb. Always. There was a time when growth felt simple. More people meant more workers. More factories meant more products. More jobs meant more spending. Everything seemed to rise together. But today, something feels different. Growth still happens, but it comes with more weight, more strain, more questions. The road forward is no longer clear. Let us look gently and carefully at the new problems shaping our future. Not dramatic headlines, but deep, slow-moving forces that are changing how the world works. The first one is right in front of us. It is our age. In many rich countries, the population is getting older. People are living longer. That is good news. But there is a flip side. Birth rates are falling. Fewer babies are being born. That means fewer young workers entering the job market. In Japan, for example, the population has been shrinking for years. The country has more people over 65 than under 15. This creates a hard problem. There are not enough young workers to support the older population. According to peer-reviewed research in the Journal of Economic Perspectives, aging societies face lower growth because spending shifts away from investment and toward healthcare and pensions. Productivity slows. The number of workers per retiree drops. That puts pressure on governments, businesses, and families. This pattern is spreading. Europe is aging. China, once known for its massive workforce, is also seeing a sharp decline in births. Even the United States is feeling it. This matters because growth depends on people, on workers, on consumers, on energy. When the balance shifts too far toward aging, the economy slows. At the same time, another challenge is growing louder: the planet itself. The Earth has limits. Climate change is no longer just a warning. It is real. It is happening now. Rising temperatures bring droughts, floods, fires, stronger storms. These hurt crops, damage homes, disrupt supply chains. Businesses pay the price, so do communities. The Journal of Environmental Economics and Management reports that extreme weather has already lowered agricultural output and damaged infrastructure in both developed and developing countries. Insurance losses have surged. Companies face growing costs to prepare for and recover from disasters. Then there is the issue of resources: clean water, minerals, energy. As the global population grows, the pressure on these resources increases. Mining becomes harder, water becomes scarcer, food becomes more expensive to produce. This puts a ceiling on growth, not just in one country, but everywhere. Companies must now balance profits with sustainability. That is not easy. It costs money to go green, but not going green may cost more in the long run. Another force is reshaping the workplace itself. Technology. For years, technology has helped growth. It made factories faster, services smoother, communication instant. But now we are entering a new phase, one that feels different. Artificial intelligence and automation are moving fast. Machines can now write, speak, draw, drive, and analyze. They do not need rest. They do not ask for pay. At first, this sounds efficient, and it is, but it comes with a worry. Jobs. When machines do the work that people once did, what happens to the workers? This is not just theory. It is happening now. Retail jobs are being replaced by self-checkout. Call center workers are being replaced by chatbots. Drivers may one day be replaced by self-driving cars. A study published in the American Economic Review found that automation has already reduced wages and employment for workers in certain sectors. And while technology creates new jobs, it does not always create them fast enough, or in the same place, or for the same people. This creates gaps. Some people move forward, others fall behind. That inequality can slow growth by weakening demand. When fewer people have good jobs, fewer people spend money. That hurts businesses. Now let us talk about another heavy burden: debt. Governments around the world have borrowed huge amounts of money. So have businesses. So have consumers. Debt is not always bad. It can help during crises. It can fund useful projects. But when it gets too big, it becomes a drag. Interest payments grow, budgets shrink, confidence weakens. According to research published by the International Monetary Fund and reported in the Journal of Financial Stability, high levels of public and corporate debt can lead to slower long-term growth and higher risk of financial instability. The world saw this clearly during the debt crises in Greece, Argentina, and other countries. Too much debt can lead to painful cuts. Markets panic. The economy suffers. Even in wealthy nations, debt levels are rising. The United States, for example, now carries debt larger than its entire economy. That limits its ability to spend on growth or respond to new crises. Now let us move to the global stage. Competition is fiercer than ever. In the past, a company in one country might face just a few rivals. Now it competes with hundreds, from every corner of the globe. A small factory in India, a startup in Brazil, a tech firm in South Korea. These are no longer far away. They are real threats to established businesses. This can drive prices down. That sounds good for consumers. But it also squeezes profits. It forces companies to cut costs. That can mean lower wages or fewer jobs. This makes it harder for any one business to grow quickly. And now, we must look at something harder to measure. But just as important, geopolitical tensions. The world feels less stable. Trade wars, sanctions, armed conflicts. These shake markets. They disrupt supply chains. They create uncertainty. When countries argue, businesses hesitate, investments are delayed, deals fall apart. For example, the trade tensions between the United States and China have already reshaped global trade. Tariffs were raised, supply lines were moved. Some companies pulled out of markets they once depended on. Research from the Journal of International Economics shows that policy uncertainty alone can lower investment and growth across industries. Finally, we face one more challenge, one that hides in plain sight: market concentration. In many industries, just a few giant companies now dominate. Think of tech, search, social media, online shopping. These giants grow fast, they earn huge profits, they buy out competitors. At first, this seems efficient, but over time, it can slow innovation. Fewer choices for consumers, less room for small companies to grow. This matters because small and medium businesses are often the true drivers of job creation. Research from the Harvard Business Review and Journal of Economic Growth shows that highly concentrated markets can limit competition and lower overall productivity in the long run. So what does all this mean? It means the future will not look like the past. The easy engines of growth are slowing. The world is older, hotter, more divided, more digital, more in debt. This does not mean growth is over, but it does mean it will be harder. It will take more thought, more balance, more care. Investors, policymakers, workers, and companies all need to understand this. We cannot expect straight lines anymore. We cannot expect yesterday's tools to fix tomorrow's problems. But there is hope in understanding. These challenges are real, but so is human creativity. We have adapted before, we have rebuilt before, and we will again. But we must see clearly. We must know the weight we carry. Only then can we move forward with purpose. The threats to growth are not coming. They are here, and how we respond will shape everything that comes next. Once upon a time, Japan was the rising star of the world. In the 1980s, its economy grew fast. Its companies led the world in electronics, cars, and finance. Tokyo's stock market became one of the most powerful on Earth. People believed Japan was the future. Books and newspapers around the world warned that Japan would soon overtake the United States. But then something changed. On December 29, 1989, Japan's stock market reached its all-time high. That day, the Nikkei index closed at nearly 39,000. Investors were excited. Everyone believed the boom would continue. It did not. In the months and years that followed, the market fell hard. It dropped by more than half. Then it dropped again and again. More than 30 years later, Japan's stock market has still not fully returned to that peak. This story is not just about numbers. It is about a country that lost its economic momentum. It is about choices, mistakes, aging, and lessons for the rest of the world. Let us go back to how it all started. In the 1970s and early 1980s, Japan's economy was strong. It was built on exports. The country made cars, televisions, radios, and semiconductors. Japanese products were seen as high quality. The world could not get enough of them. Japanese companies were supported by banks. These banks loaned out large amounts of money at low interest. Land prices soared, so did stock prices. People borrowed more and more. They used their rising real estate as collateral. The cycle continued. This was the bubble. By the late 1980s, real estate prices in Tokyo were so high that a small piece of land in the city cost more than entire cities in the United States. Everyone believed the price would keep rising, but bubbles do not last forever. In 1990, it all came crashing down. The Bank of Japan raised interest rates to control the bubble. That move made borrowing more expensive. Stock prices began to fall, so did real estate. People could no longer repay their loans. Banks were left with bad debt. This was the start of what would become known as Japan's lost decades. From the early 1990s through the 2010s, Japan's economy barely grew. According to peer-reviewed research from the Journal of Economic Perspectives and data from the World Bank, Japan's average GDP growth rate fell below 1% during this period. The government tried to fix it. They spent money on public projects. They lowered interest rates. They offered support to banks. Nothing seemed to work. What went wrong? There were many reasons, but let us focus on three big ones. First, the banks. After the bubble burst, Japanese banks were full of bad loans. But instead of dealing with them quickly, they waited. They kept lending to troubled companies, hoping they would recover. Economists call these firms zombie companies. They do not grow, they do not die. They just hang on, using up resources. This slowed the recovery. Second, the people. Japan's population was getting older. Fewer young people were entering the workforce. At the same time, older people were retiring. This created a heavy burden on the economy. A study published in the Journal of the Japanese and International Economies shows that aging slowed both productivity and consumption. When people age, they spend less. They save more. That lowers demand in the economy. Third, the prices. Japan entered what economists call a deflation trap. That means prices fell year after year. At first that may sound good. Lower prices, cheaper goods. But in reality, it hurts. When prices fall, people delay spending. They wait for things to get cheaper. Businesses earn less, profits fall. They stop hiring, they cut wages. That leads to more saving and less spending. The cycle continues. The Bank of Japan tried to stop it. They cut interest rates to zero, then below zero. They tried quantitative easing. They pumped money into the economy, but prices stayed flat. Why was it so hard to fix? One answer lies in culture. Japan is a very cautious society. Companies are conservative. They avoid risk. They focus on stability, not speed. This worked well during the years of fast growth. But during the slowdown, it made change harder. Young people in Japan tend to seek safe jobs. Many avoid starting new businesses. Innovation slows. New companies struggle to compete. The old ones stay in place. At the same time, women are underrepresented in the workforce. Many are highly educated but do not return to work after having children. That means Japan is not using all of its talent. These cultural factors, combined with economic ones, created a long period of slow growth. This is why economists and leaders in other countries watch Japan closely. Could the same thing happen elsewhere? In Europe, birth rates are falling, populations are aging, government debt is high, banks are cautious. Some fear a European version of Japan's lost decades. In the United States, things look different. The economy is more flexible. There are more immigrants, which helps population growth. The culture rewards risk-taking, but still, the lessons from Japan matter. For example, when the 2008 financial crisis hit, the United States acted quickly. It forced banks to deal with bad loans fast. It supported demand through stimulus. That helped avoid the kind of long freeze that Japan went through. Still, some of the same dangers remain. High debt, slowing growth, uneven demographics. That is why the Japan story is more than history. It is a warning, a reminder that even the strongest economy can stall. Even the most admired companies can fall behind. Even the richest societies can stop growing. But Japan's story is not over. In recent years, the country has made changes. It has started to open its labor market. It has worked to include more women in the workforce. It has embraced more digital technology. Some policies have helped. Prime Minister Shinzo Abe launched a plan called Abenomics. It aimed to boost the economy through 3 tools: monetary easing, government spending, and structural reform. The early results were mixed, but they showed effort. They showed that change is possible. Now, Japan is also investing in green energy, in artificial intelligence, in robotics. These may be areas where it can lead again. The road back is slow, but it is still open. Japan's lost decades hold many lessons. The danger of letting bubbles grow too big, the cost of avoiding hard choices, the importance of dealing with bad debt quickly, the risks of a shrinking workforce, the deep damage of falling prices. But also this, that even after 30 years, recovery is still possible. That with the right changes, new growth can begin, and that no economy, no matter how strong or weak, is ever truly stuck, unless it gives up. The world can learn from Japan, not just how to avoid its mistakes, but how to stay patient, how to face challenges honestly, how to keep working toward a better future. Because sometimes the biggest warning is also the quietest. Not a crash, not a crisis, but a slow drift. A drift into stillness, into silence, into stagnation. And that is a lesson no country can afford to ignore. When most people think about the stock market, they picture fast moves, screens full of numbers, people yelling, big wins, big losses. But that is not how professional investors think. That is not how they build long-term wealth. The smartest investors do something different. They play a slower, deeper game. This is the story of how they do it. The first rule they follow is simple. Never put all your money in one place. It is called diversification. Imagine you grow apples. One year, a storm destroys your orchard. That year, you lose everything. But what if you also grow oranges in another field, or rice in a different valley? Even if one crop fails, the others keep you going. That is the idea behind diversification. Professional investors do not just buy stocks in one country. They buy across the world. They do not only pick one industry, they own pieces of many industries, some tech, some healthcare, some energy, some real estate. They also invest in different asset types, stocks, bonds, real estate, sometimes even commodities like gold. Why? Because different things do well at different times. When stocks fall, bonds might rise. When real estate slows, gold might shine. According to peer-reviewed research published in the Journal of Portfolio Management, diversified portfolios reduce overall risk without giving up much return. Diversification does not guarantee gains, but it helps protect against deep losses. It smooths the ride. And for professionals, that matters more than trying to beat the market every year. The second idea they follow is patience. Professional investors think in decades, not days. That's what we call the time horizon. When you look at 1 month of stock market returns, anything can happen. You might gain 10% or lose 10. The market jumps around. But if you zoom out to 10 or 20 years, the picture gets clearer. Over long periods, the ups and downs start to balance out. The overall trend becomes more visible. A study in the Financial Analyst Journal found that the longer your time horizon, the more predictable your investment returns become. That is why professionals often ignore short-term noise. They do not panic when the market dips. They do not chase the hottest stock. They trust the power of time. Still, they do not take risk lightly. They manage it. Smart investors do not only hold stocks. They add things that behave differently. They use bonds. These are loans to companies or governments. Bonds usually provide steady income. They do not rise as fast as stocks, but they tend to fall less when markets drop. They invest in real estate. It produces rent. It grows slowly but steadily. They might hold a little gold or other commodities. These can act as a shield during inflation or crisis. This mix helps protect the portfolio. It is like building a house with more than one support beam. If one cracks, the others hold. Risk is always there, but the goal is to reduce its impact. Next comes something even more personal. A quiet trick that works best when done consistently. It is called dollar cost averaging. That means investing the same amount of money at regular intervals, no matter what the market is doing. If prices are high, you buy fewer shares. If prices are low, you buy more. Over time, this helps you avoid buying only at the top. You stop trying to time the market. According to the Journal of Financial Planning, dollar cost averaging reduces emotional stress and can produce solid results, especially for long-term investors who invest in volatile markets. This is one way professionals reduce emotional mistakes. Emotions are powerful. Fear and greed can lead to bad decisions. That is why professionals follow another habit. They rebalance. Rebalancing means checking your portfolio once or twice a year. You look at what has grown too big. Maybe your tech stocks doubled. Now they make up too much of your portfolio. That adds risk. So you sell some of those winners, and you buy more of what has lagged, maybe bonds or other stocks that have been left behind. This feels strange. You sell what has gone up. You buy what is down. But it works. It keeps your risk level steady. It stops your portfolio from tilting too far in one direction. Research in the Journal of Wealth Management shows that rebalancing helps reduce volatility and improves long-term returns. Another thing professionals always prepare for is trouble. They know that crashes happen, recessions come. That is why they always keep some cash aside. Not a lot, just enough to handle an emergency. This is not about fear, it is about flexibility. If the market drops, cash gives you the power to buy at lower prices. If you lose your job, cash keeps you afloat without selling your investments at a loss. This is a part of what they call emergency planning. Even the best investors cannot predict the future, but they can prepare for it. Finally, what do professional investors actually do with their money? What happens inside pension funds, university endowments, or hedge funds? They follow the same rules, but with more tools, more data, more research. They build big portfolios, often worth billions. They spread their money across the globe. They hire analysts to study markets. They use computer models to test different scenarios, but the heart of it is the same. They diversify. They stay patient. They manage risk. They rebalance. They hold cash. For example, the Yale University Endowment is known around the world for its smart approach. Under David Swensen, it used a wide mix of assets: stocks, bonds, real estate, hedge funds, private equity. It avoided putting too much in any one place. It trusted long-term trends. It focused on steady, real growth. That strategy helped Yale's fund grow by billions over time. Another case is the Canadian Pension Plan Investment Board. It manages money for millions of Canadians. It uses a global approach. It invests in public stocks, private companies, real estate, and infrastructure. It balances risk and reward. It focuses on the long game. These are not secret tricks. They are just good habits. The kind that take time, the kind that most people can learn. So what can we take from the smart money? We can learn that wealth is not built overnight. It is not about chasing the next big thing. It is not about guessing right. It is about staying steady, owning many things across many places, holding them for many years, avoiding fear, avoiding greed, trusting time, trusting discipline, and remembering that smart investing is not flashy. It is quiet. It is patient. It is prepared. And in the end, that is what works. When you turn on a light, when you send a message to a friend far away, when you unlock your phone with your face, you are using something that did not exist just a few decades ago. That is the quiet power of human invention. It changes our lives. It opens new doors, and it gives the stock market something priceless, a reason to keep growing. Let us go back to the beginning, not to the very start, but to a time when the world began to change in ways that still shape us. In the late 1800s, electricity arrived, first as a spark, then as a revolution. Thomas Edison did not just invent the light bulb. He changed how people lived at night. Cities stayed awake longer, factories ran faster, households became safer. Then came the automobile. It made the world smaller. People could travel, trade expanded, jobs were created in steel, rubber, oil, roads, and repair. Every time we invent something big, it creates ripple effects. The telephone, the airplane, the washing machine. Each new thing added something to the economy. Each invention created new companies, new jobs, and new forms of wealth. Then came the computer and the internet. At first, they were for a few. Big, expensive, and slow. But over time, they shrank. They became cheaper, faster, smarter, and they changed everything. The way we shop, the way we learn, the way we work. From Silicon Valley to Singapore, tech companies were born. Some failed. Others became giants. Apple, Amazon, Google. These are now among the most valuable companies on Earth. And they did not just grow alone. They pulled up whole industries with them: advertising, logistics, cloud computing, cybersecurity. Innovation is not a single flame, it is a fire that spreads. Now we stand at the edge of another wave. Some say it is the biggest one yet: artificial intelligence, machines that can learn, write, speak, see, decide. At first it sounds like science fiction, but it is already here. AI helps doctors find disease. It helps drivers avoid accidents. It helps businesses understand what customers want. According to a study in the Journal of Economic Perspectives, artificial intelligence could add trillions of dollars to the global economy over the next few decades. But it is not just about money. It is about speed, accuracy, scale. What once took hours now takes seconds. That kind of power creates new value. But that is not the only change happening. Look outside. The world is getting warmer. The old way of powering our lives is hurting the planet. Now, a new energy story is being written. Solar panels, wind farms, batteries that store energy for the night. They are not perfect, but they are getting better, faster, cheaper, cleaner. Countries are shifting away from coal and oil. Cities are installing solar roofs. Car makers are building electric models. This is not just about saving the Earth. It is a massive business opportunity. The International Energy Agency reports that investment in clean energy could reach $2 trillion per year by the end of this decade. New companies are growing fast. Some make solar cells. Others build wind turbines. Some design batteries for homes. This energy revolution could fuel stock market growth for years. Now look up, not at the sky, but beyond it. Space is becoming more than a dream. Private companies are launching rockets, satellites are beaming down data, space tourism is being tested. Some people are even talking about mining asteroids or building bases on the moon. It sounds far off, but so did smartphones once. NASA and private firms like SpaceX and Blue Origin are pushing the boundaries. As these efforts grow, they create jobs on Earth, in software, in robotics, in engineering. Space is not just a science project anymore. It is becoming an industry. Now let us look inside the human body. Medicine is changing too. Doctors are not only treating sickness, they are starting to slow aging. Gene editing tools like CRISPR allow scientists to change DNA. Biotech firms are working on ways to fight cancer at the cellular level. Some researchers are even exploring how to help people live longer, much longer. According to peer-reviewed research in Nature Biotechnology, the next wave of medical advances could lead to entirely new markets. If people live longer, they may work longer, spend more, save more. That keeps the economy growing. This is not just about labs and scientists. Startups are at the heart of these stories. They're small at first. Just an idea. A few people, a garage, a dream. But some grow. They attract venture capital. They build something new. They hire, they expand. That's how big companies start. Google began in a dorm room, Facebook on a college campus. Now they are part of daily life. According to the Journal of Business Venturing, startups are responsible for a large share of job creation and innovation in the United States. When startups succeed, they often go public. That means they list their shares on the stock market. Investors buy those shares. If the company keeps growing, the share price rises. That creates wealth. And this is where the innovation engine meets the investment engine. New ideas lead to new companies. New companies lead to new jobs. New jobs lead to more income. More income means more spending. More spending helps the economy grow. And the cycle continues. Now think about the world you live in. You use apps to book rides, to order food, to pay bills. You watch movies on demand, store photos in the cloud. Your phone is more powerful than the computers that once sent people to the moon. This is the digital transformation. It is changing every part of business, how we work, how we sell, how we communicate. A small shop can reach customers worldwide through a website. A teacher can reach thousands of students through an online course. A hospital can consult experts across the globe with a single video call. Data is now the most valuable resource. According to the Harvard Business Review, companies that use data effectively grow faster, serve customers better, and adapt more quickly. That is why software companies are growing fast. They help other businesses move faster, work smarter, serve more people. So what does all this mean for the stock market? It means there is fuel for the future. Not guaranteed, not perfect, but powerful. Innovation does not move in a straight line. There are failures, delays, hype, disappointment. But over time, the story is clear. From steam engines to smartphones, every wave of invention has made the world richer. And that richness is not just about money. It is about better health, better tools, better choices. That is why human creativity is the deepest reason to believe in long-term growth. Markets rise and fall, but people keep solving problems. They keep dreaming. They keep building. And as long as they do, the engine keeps running. Imagine walking through a forest. The sun is out. The path looks safe. But then you hear the birds go quiet. The wind shifts. The sky darkens just a little. You stop. You sense something is not right. That is what reading the warning signs feels like in the world of money. You do not always know the exact moment when something will go wrong. But if you listen closely, if you watch with care, you can sense the change. The stock market is like that forest. Calm one day, stormy the next. The goal is not to predict every step. The goal is to notice when the conditions are changing. Professional investors, economists, and analysts do not have crystal balls, but they do look at signs. Signs that warn of a slowdown, a crisis, a crash. Let us explore those signs together, slowly, clearly. The first place they look is the economy itself. This is where they watch the basics: jobs, prices, growth. If a lot of people are losing jobs, that is a red flag. It means businesses are cutting back. That means people will spend less. And when spending slows, the whole economy feels it. Unemployment is more than a number. It is a story about fear, about families pulling back, about demand shrinking. When inflation gets too high, that is another warning. Inflation means prices are rising. When it moves slowly, it is normal, but when it moves fast, it can hurt. It makes everything more expensive. Food, gas, rent. People have less money to spend. Businesses struggle. Governments and central banks then step in. They raise interest rates to cool inflation, but higher rates also make it harder to borrow and grow. So inflation, when out of control, can pull growth down. Then there is GDP. That stands for Gross Domestic Product. It is the total value of everything a country produces. When GDP grows steadily, the economy is healthy. When it shrinks, especially for more than 2 quarters, that can mean a recession. These 3 signals together, unemployment, inflation, and GDP, form a picture. If all 3 are flashing yellow or red, smart investors pay attention. Next come the signals from the markets themselves. These are a little harder to read, but they can be just as powerful. Watch how prices move, not just up or down, but how fast and how wide. When prices swing wildly without clear reasons, that is a sign of stress. When trading volume suddenly spikes, especially on days when prices fall, that can mean fear is building. When more people are buying safe assets like government bonds or gold, that can mean investors are nervous. Even the way investors talk can be a clue. Are people acting excited, talking about getting rich fast? That might be a sign of a bubble. Are people panicking, selling everything at once? That might be a sign of a bottom. Investor behavior is often emotional, but those emotions show us something real. They show how much risk people feel. And when fear or greed runs too high, trouble may follow. Now look outside the markets. Look at the world. Politics and power can shake the markets too. When countries hold elections, uncertainty rises. People do not know what policies will come next. Will taxes rise? Will trade rules change? Will new leaders bring calm or chaos? Markets do not like confusion. When wars start, when protests spread, when leaders fall, these events move markets. For example, the Brexit vote in the United Kingdom caused a sharp market drop overnight. So did the surprise election of leaders in other countries. Sanctions, tariffs, border closings. These all add stress to businesses and investors. So when the news from governments and leaders gets shaky, markets often respond. Another signal to watch is the shape of asset prices. Sometimes things get too hot. When a stock or house or crypto coin rises too fast, without strong reasons behind it, that may be a bubble. Bubbles look exciting. Everyone wants in. But they are dangerous. History is full of them. The dot-com bubble in the late 1990s. Tech stocks rose without profits. Then they crashed. The housing bubble in the early 2000s. Home prices soared. Loans were easy. Then it all collapsed in 2008. A peer-reviewed study in the Journal of Economic Perspectives explains how bubbles form when prices move far beyond what the real earnings or value can support. The warning sign is speed. When prices double or triple in a short time without earnings keeping up, trouble may not be far behind. Also, look at the health of companies, not just their stock price. Look deeper. Are they making profits? Are they drowning in debt? Are their costs rising faster than their income? These things matter. A company can have a high share price but still be weak inside. If that weakness spreads to many companies, the whole market can suffer. That is why analysts study balance sheets. They look at debt levels, profit margins, cash flow. When those signs start to fall, smart investors take notice. Now think globally. We live in a connected world. A factory in one country can shut down businesses in 10 others. A shipping delay in one port can raise prices in stores around the globe. So when one economy stumbles, it can ripple outward. A banking crisis in Europe, a currency collapse in South America, a slowdown in China. All of these can shake markets in the United States. The 2008 crisis started in the American housing market. But soon, banks in Europe were affected. Trade slowed. Stocks dropped everywhere. This is called contagion. One problem becomes many. That is why global investors watch news from every part of the world. Even a small country, if it holds key resources or has deep financial ties, can send shockwaves. Lastly, we must learn from the past. History does not repeat exactly, but it does rhyme. Before every major crash, there were signs: too much optimism, too much borrowing, too much risk. Before the Great Depression, before the dot-com collapse, before the 2008 crisis, the signs were there. Prices rising too fast, warnings ignored, worry pushed aside. That is why smart investors study history. They compare today's conditions to those from the past. They look for patterns, not to be afraid, but to be ready. According to research in the Journal of Financial History, markets tend to overheat when interest rates are too low for too long, when debt levels climb, and when investor optimism becomes extreme. These patterns do not guarantee a crash, but they raise the chances. So what should we do with all these signs? Watch them. Do not panic, but do not ignore them either. Knowing what to look for helps us stay calm when others are not. It helps us make better choices. It helps us protect our money. The market will always rise and fall. That is its nature. But the biggest losses often come not from the fall itself. They come from not seeing it coming or from reacting too late. So read the signs, listen to the numbers, watch the behavior, learn from the past. Because even in the forest, before the storm breaks, the air changes, and those who notice it early are the ones who find shelter first. Money is a quiet force. It does not shout, it waits. It watches how you treat it. If you respect it, it grows with you. But if you ignore it, rush it, or fear it, it can slip away. That is why you need a personal battle plan. Not just a list of tips, but a clear path, one that fits your life, one that helps you sleep at night, one that is built for what lies ahead, not just what came before. Let us start with something many people ask. Will the stock market always go up? History gives us reason to believe in growth. Over the past 100 years, markets have gone up more than they have gone down. They have recovered from wars, crashes, recessions, and pandemics. Peer-reviewed studies, including those in the Review of Asset Pricing Studies, show average real returns of around 4 to 7% per year over long periods, even after inflation. But there is no guarantee. No rule says the future must look like the past. That is the first truth in your plan. The market is a probability game. The odds are in your favor, but risk is always there. You cannot remove risk, you can only manage it. That starts with your timeline. How old are you? How long until you need this money? What is it for? A 25-year-old saving for retirement has time to take more risk. They can ride out crashes. They can wait for recoveries. But a 55-year-old planning to retire in 10 years needs a safer plan. They cannot afford deep losses right before retirement. This is why age matters. It shapes your investment mix. Younger people can hold more stocks. Older people might add more bonds or cash. Your goals also shape your plan. Saving for a house in 2 years is not the same as saving for retirement in 30. Short-term money should be safe, not tied up in the market. Long-term money can take more risk. But even before you invest, you need something else. An emergency fund. This is money you keep in a savings account. Easy to reach, safe. 3 to 6 months of living costs. Rent, food, bills. This is your first defense. If your car breaks down, if you lose your job, if a health bill comes, you do not touch your investments. You use your emergency fund. That way, you're never forced to sell stocks during a crash just to pay for groceries. Once that is in place, you can start investing. But go slow. You do not need to jump in all at once. Start small. Put in a little each month. This is called gradual entry. It helps you learn. You get used to seeing your money move up and down. You start to understand your own emotions. Some months the market will drop. That is normal. Over time, you grow more confident. As you earn more, you invest more. This is how habits grow. Smart investors also know they cannot win by picking just one thing. They spread their money, not just across different stocks, but across different asset types. Bonds are one. They pay interest. They move differently than stocks. When stocks fall, bonds often rise. Then there is real estate. It can bring steady rent income, and it grows over time. Then there are international investments. Do not put all your bets in one country. The world is big. Growth comes from many places. Finally, there are alternative assets. Gold, commodities, even carefully chosen private investments. They are not for everyone. but they can add balance. This is called diversification. It does not remove risk, but it helps you spread it. Now let us talk about time. Not just how long you invest, but how often you check. The truth is, you do not need to look at your investments every day. That can create stress. Instead, check once or twice a year. Look at how each part of your portfolio is doing. Maybe your tech stocks have grown a lot. Maybe your bonds have stayed flat. That is okay. But now one part is too big. This is when you rebalance. You sell a little of what has grown too fast. You buy a little more of what has fallen behind. This keeps your plan steady. It stops you from drifting into too much risk. This brings us to something harder to master: your emotions. Money stirs deep feelings: hope, fear, greed, panic. When the market crashes, it is easy to panic. But selling during a crash locks in your losses. You turn a paper loss into a real one. The smart investor stays calm. They know crashes are part of the journey. They remember the long view, and when prices are low, they might even invest more. Because every crash in history has been followed by a recovery. Still, hope is not a strategy. You need a plan B. What if the market stays down for 5 years? What if your job is cut? What if your health changes? Plan B means you are not caught off guard. Maybe it is a second income stream. Maybe it is a plan to delay retirement by 2 years if needed. Maybe it is keeping a little more cash than usual. It is not fear. It is readiness. Just like you carry a spare tire in your car, not because you expect a flat, but because one might come. Smart investors always carry that tire. Now let us think beyond just you, your children, your grandchildren. Your investing choices today can shape their future. If you save and invest wisely, you may leave something behind, not just money, but habits, lessons. You can teach them to save, to invest, to think long-term. This is called legacy thinking. It is not just for the rich. Every dollar you grow with care becomes a seed. It can fund education, a business, a down payment. It can show the next generation how to build wisely. That is real wealth. So what is the final answer? Will stocks keep going up? No one can promise that. But history gives us reasons to believe, and your battle plan is not built on hope alone. It is built on habits, on discipline, on balance. You do not need to be perfect. You just need to stay consistent, prepare for the worst, hope for the best, and keep walking your path. Because in the world of money, it is not about being lucky. It is about being ready.